Today, rates, how low will they go? Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and property news with a distinctively Australian flavour. Today I'm joined again by Steve from Canstar. Hi Steve.
Hi Martin.
Thanks very much for spending some time with us. A perfect time for a conversation after yesterday's RBA rate cut. But you'd already published some earlier research that was highlighting that rates have come down for both depositors and borrowers, more so for depositors. And I'm afraid there's even more significantly bad news now for depositors, isn't it?
Oh, look, it is. Depositors have been smashed, absolutely smashed, for the last couple of years, to be honest. Even before the RBA started cutting, the banks did. And over the last year, we've seen bonus accounts go down. In the last 9 months, so since the start of 2020, bonus rates gone down 0.58, regular savings 0.61. Term deposits, 6 months term deposits by 1.63. So well above the RBA rate cuts, and this is before this latest cut by the RBA.
Yeah, and it's interesting, if you look at the recent Westpac and ANZ results, they had significant margin compression, but they clawed some significant amount back by squeezing the deposit rates even harder.
Yeah, absolutely. I mean, there are two things that go on. One, the rates being offered to home borrowers, new home borrowers, or refinances to a new organisation are very, very attractive. But of course, they've held on to a little bit of margin with the existing borrowers. Yeah. Plus, they really have smashed the savers. Now, the realities are that the wholesale rates are so attractive. And of course, they've got that term funding from the RBA as well, which has also gone down from 0.25 to 0.1. With all of that low-cost wholesale funding, they just don't want to pay depositors much more than that. They're prepared to sort of let it slide down, don't want to lose the customer base, so it'll be a fine balancing act for them. But they've certainly held on to some margin.
And of course, the fact of the matter is that there are many households who have, over the last few years, been very reliant on income from term deposits and also call savings accounts. Their incomes have been squashed. And it's interesting because I don't see really much discussion about that. It's all about mortgage rates and how great the mortgage rates are. Nobody's really talking about the large number of people that are being severely impacted by this.
Look, I think we've finally got some people talking about it in the media, but it's still a minority. It's still that headline home loan rate that people focus on. And it's not even the rate that existing borrowers get. It's the rate that new people are getting. Now, of course, the RBA wants to see those rates fall. But look, we've done a recent survey that says that to increase spending, it's an absolute minority that say lower home loan rates will increase spending for recovery. More people are actually saying higher savings rates. So, you know, it's a balancing act the RBA is playing, and they've come down in favour of borrowers at the moment because it flows through to business loans as well. But, you know, it's a real focus in most places on home loans. Savers get forgotten.
Yeah. And again, in my surveys, I see this, the 3 million or thereabouts of households who are reliant on these are basically saying, we're going to hunker down, we're going to spend less because we're not seeing any income. They're very worried about tapping into capital because obviously once you've spent your capital, it's hard to recover, particularly when wages are not growing and where jobs are under pressure at the moment. So it really does beg a very significant question for many people now, which is, do they continue to put their money in the banks or do they actually decide to take market risk? And of course, the Reserve Bank is sort of quite keen for people to take market risk, aren't they?
Well, I think they're backing people into that position. You cannot live off interest if you only are getting an average rate of, on a term deposit, 1.23%. That doesn't go very far unless you've got some millions of dollars in the bank. And inflation, anyway, is eroding it. So you're going backwards. You must be living off principal as well as interest. And the fact is that people have to put it into a higher yielding investment somewhere. And that's why, of course, the dividend play has been such an attractive play to people.
Mm. And of course, many people were also in the banks with dividends from the banks, and the banks are cutting their dividends as well. So, wherever you look, returns are significantly under pressure.
Yeah, well, that's right. That dividend play was really all about the big four Australian banks, and most of them have come out and said, well, no dividend this time around. So yeah, that hurts a lot, and so people are being driven to more risk. There's no question.
Right. And what does that say about confidence? Because I noticed that in your surveys, you were underscoring the fact that what we really need is stronger levels of confidence, because people are perhaps going to be more optimistic if they're more confident. Some of these recent moves, though, would I suggest be taking confidence the other way?
Yeah, well, they do. If you see rates virtually at zero, there's only one reason they're there, and that's because the economy is in such a mess. Which also goes, of course, to the budget, because, the budget came out and said the big thing we're spending all this huge deficit on is encouragement to business to invest. Now, do they invest when they're faced with uncertainty, with a project that might or might not work? Well, not really. You don't do it just for the tax benefit. So, that policy setting is, in some doubt.
Well, I have to say that I was very unimpressed with the budget, because it didn't seem to me that they were actually supporting the small business sector, which is really struggling. They're finding it very difficult to get funding from the banks. Despite all this liquidity being thrown towards the banks by the Reserve Bank, many small businesses can't get the funding they need, and they're not really able or willing to invest at the moment. So wherever you look, you sort of have to say, why are we going down this route?
Well, you do, and you look at it and you think, well, what route can we go down? And the Reserve Bank is sort of at almost the end of their tether, I think. They don't want to go negative rates. No one wants to see negative rates if we can avoid them. So they're at the point where they look at it and say, not sure that we can do anything more. It's over you, government, which, of course, Philip Lowe has said a number of times. But I'm looking at it thinking, gee, maybe infrastructure deserved a bigger part in that budget.
Yeah, I agree. I think it was misplaced, and I think we're paying, a lot of money. Okay, rates for government spending is very, very low, and that's one of the reasons why rates are low. But it's a big number in the budget, a big hole in the budget, and it's got to be paid back at some point. But unless it's directed into the right areas, it's not necessarily going to drive the right outcomes.
Look, that's right. You look at the big depreciation, the instant write-off, and you think, well, gee, the successful businesses are going to be driving around a lot of brand new Mercedes and BMWs, aren't they? and I'm not sure that's going to add a lot to the productive capacity of Australia. And that's one of the real risks, that there'll be a lot of misguided spending, but by those that can afford it. And those that are in a little lesser shape, well, they're not going to be spending anything, frankly. It's there's too much uncertainty, too much risk.
Yeah, and the data came out today with the payroll data. In fact, that was going backwards. So, in fact, the overall pay flowing in the economy is going down. And we also know that there are still more businesses coming on to JobKeeper. So, while some are coming off, there are more going on even at this stage. So, again, another indicator that things are not well.
Yeah, and look, there's going to be. I've looked at the property market. I know you probably share a similar view about the property market, and I'm quite stunned that it hasn't adjusted in some way or another. And some markets are even going up, but there's a lot of water to go into this bridge yet. We've got people still on repayment pauses, and that comes really to an end in a few months' time. Sort of early to mid-year next year. And JobKeeper comes to an end as well, and the solvency laws, that relaxation, well, that's going to come to an end as well. Now, when all of that happens, we will see a bit of a change here. We'll see some properties coming onto the market, and some pressure on prices there. And so I think there's a lot of optimism at the moment that's a little bit misplaced. And you wait 6 months and see all of these things play through, and maybe then is the time to say, all right, we're through the worst of this. A little too early yet, though.
Well, I keep saying we're in the foothills of this crisis, not coming out of it, right? So there's a more of a cliff to climb. And of course, the Reserve Bank did say yesterday that they expect unemployment to be, around 8%. It was 10% previously, so that's better than they were expecting, but then still above 6% in a couple of years' time. So we're still going to see a lot of water to go under the bridge yet before we really see a way out of this.
Yeah, absolutely. And one of the things that I kind of think is sort of a kind of weird psychological signal is that people say, look, we've come out of recession the minute we see a positive GDP number for a quarter. And I look at it and say, well, we haven't really. Let's say our economy contracted 10% and then next quarter it's up 1%. Well, gee, that's not going to add to those jobs that people need. It's when people get back into work and the unemployment's down, that's when you can say the recession's over. And we're not even at the start of that. We're still building to that.
Yeah, absolutely. Well, remember that in the US and in the UK after the global financial crisis, the worst to house prices and the worst unemployment hit 3 years later.
Yeah, and that's right. There's a lag in all of this. And in the early stages, the psychology people have is, look, I'm going to hold on. I'm not going to meet a market. So nobody wants to see their property price fall. Nobody wants to realise a lower price. The time will come when there will be extra job losses. There will be people who the banks will say to, well, look, sorry, but this has been a year and we don't see your position improving enough. You've got to do something about it. You've got to get out. And frankly, we'll see all of this and those decisions will come. So there's this natural lag before you hit the bad times.
Absolutely. Now, the other thing I wanted to discuss before we close out is the mortgage rate discussion, because CBA and Westpac have announced that they are actually offering lower new loan rates for fixed rates, right? But of course, they're not adjusting their variable rate. So what that says is no loyalty. If you're going to actually want to get the best rates, you're going to have to switch. You're going to have to do some hard legwork.
Yeah, look, you might twist their arm into saying we'll give you that deal because we're giving it to new borrowers, but it's a bit of arm twisting has to go on to get that. You have to make yourself, for most people to get the best out of this market, you have to make yourself a new borrower at a lender. So, and that's the way to get the best out of it. If you're not in that situation, you've got to be a great negotiator. So it's tough because you're right. Existing borrowers have not received a whole lot of joy over the last 6 months. They've had a couple of decreases when the RBA has gone down, but in some cases they've received almost nothing. The new borrowers are getting great headline rates. So you've got to make yourself a new borrower. And that means changing institution. And, you can always go back and negotiate with your existing guys when you've got a firm deal on the table.
Yes, you have to actually be able to use some heavy arm work to be able to get them to come to the party, right? And the best is the threat. I'm going to move because I've got this other offer over there. They might come to the party, and sometimes they do, sometimes they don't. These days, of course, at the moment, banks are being a little bit selective in terms of who they actually take in terms of new business, right? The lower risk business is the one they want, not the higher risk business. So it'll be interesting to see how that plays out. But those rates, those new rates, is it 1.7% or something is the best fixed rate out there? Yeah. I mean, they're a great example of what you're saying, because the new rates, the super low rates, are for lower LVRs, low loan to value ratios, so people with much more equity. And that's because lenders, are saying there is a lot of risk in this market. We are not prepared to put ourselves in this risk. If we're going to provide very sharp price loans, we want to make sure that the equity buffer means that we don't lose money, even if the borrower eventually can't repay. So that's where we're seeing some really sharp deals, and we'll see some more over coming days. We've already seen people shaving 10, 15% off loans after this last cut. And, within a day, we'll see more, but it will all be for new, and the very best deals will be for lower LVR customers. It's also why refinance is so big at the moment. People are saying, lenders are saying, these people have a track record, they're repaying currently, have been for years, and they've built up equity. They're the sort of customers we want. Yes, and the refinancing situation is quite interesting because I do see in my data some people refinancing with a bigger loan. So not only do they move from bank A to bank B, but they just take a bit more equity out of their property on the way through to clear off other debts and things as well. So that's another reason why the total borrowing pool is actually increasing slightly.
Yeah, look, if that's widespread, then there's a real problem on their hands, because you're taking something that's probably a 1 or 2 year commitment and turning it into a 30-year commitment. And hopefully people who do that are applying a lot of discipline and saying, well, you know what, I really have to behave as if I'm repaying this little bit over here faster. Or they end up actually paying a whole lot more interest over the lifetime of a loan.
And I sometimes say, the banks think differently to us in terms of how they look at customers, right? Because basically a customer who continues to pay is cash flow, and that's all they want, as long as the cash flow continues. And if it runs for 20 years or 30 years, that's actually to their benefit rather than the consumer's benefit.
Yeah, absolutely. The best customer to a bank is somebody that is very loyal to the bank and doesn't push them too hard on interest rates. Has been there for a long time, has nice equity, keeps making their repayments, and never repays early. That's the best customer.
Yep, and it's the same people who revolve on their credit cards.
Especially if they're on a high-price rewards card, paying 24%.
Absolutely. And what about your perspective with regard to the lending changes? Now, of course, ASIC's responsible lending rules are likely to disappear next March. Have you got a perspective as to whether that's really going to have much impact or not?
I actually don't believe it will, to be honest, because I think we are seeing this conservatism amongst lenders right now. They're not going to take ridiculous risk. They're chasing business hard, but they're not going to go out there and just they're not going to say, look, there's a big pile of money in the corner, go and take what you want and leave an IOU. It's not the time not to do that. They're after the high quality end. So I don't think it will change that. I think down the track it might. I think where that changed a little bit, unfortunate, is in the more consumery lending end of the market. So credit cards are really an area that disappoints me there, because people obviously do need some protection from themselves with credit cards. But home loans, I don't see it making much of a difference for quite a while, maybe if ever, to be honest.
Well, it's rather similar to the view I have, which is that with the enhanced APRA risk guidelines that are already there, there are other parameters being set to ensure that the loan portfolios are not under risk. But it is important for people to understand that, if the bank says you can have a loan, they're not necessarily assuming that it's the right thing for you to do, right? All they're saying is, yeah, you can probably meet our lending standards, right? And I often say to people, remember, there's a difference between you being comfortable with the loan you're getting and a loan that the bank might say, yeah, you can have that, and I still get stories of very large loans being offered to people on relatively low incomes. So just because the bank says yes, think twice.
Yeah, that's absolutely right. And then there's the other category of people that say, how do we trick the bank into giving us this loan? Now, that is really fraught. If you are actually going out there and finding a way of being deceptive about your income or your expenses, you probably deserve what you get. But you're right. There are still people who, look, the majority of people get a budget and get when they're borrowing a house, they get it. But there are there's an element of people who do struggle to understand the numbers. And I guess it'd be nice if we could find a way to help that group out without slowing it up so much for the majority that it becomes almost unworkable, which we saw, I think, in the immediate aftermath of the Royal Commission, where delays were just immense and some very strange questions were being asked by banks.
Yeah, absolutely. And, my intelligence tells me that some of the banks are looking to sort of trim back some of those questions a little on the on the argument they'll be able to put the acid back on the individual borrower rather than being responsible themselves, which I think is a bad thing, by the way. I think the bank should have some responsibility. But nevertheless, I don't see this is going to necessarily open the lending taps. Okay, last question, Steve. The Reserve Bank governor yesterday came out and said, don't think negative interest rates are going to come anytime soon. He, of course, previously said rates won't drop below 1.5% and then some won't drop below 0.75%. So do we believe him on negative rates?
I think I do. I mean, there's a big difference between having a 0.1 in front of a number and having a big round zero, let alone a minus sign. And I would hate to think we would get to the point of negative interest rates. The moral impetus for responsible decision making disappears when you're being paid to borrow. And some dumb decisions will be made, some short-term decisions, some ridiculous investments. It's just a dangerous place to be. And it's also such a bad signal about the economy.
Well, it does. And of course, there are negative rates in Europe. In Germany, some people are actually being charged now to hold money in deposit accounts. There are a couple of mortgages that are actually paying you, although you have to pay fees. So actually, net, you're still actually paying a little bit. But it does really turn banking on its head. So let's hope that he doesn't go there. But I just worry that, every time they say never, then they say, well, maybe, and then they do it. Yeah. So we'll see.
Oh, look, maybe it wasn't a core promise. It was it was a never, well, maybe, but probably not.
Steve, I really appreciate your time today. This is a really important time to be chatting with you guys about, the rates. And it's worth, of course, underscoring that you have a very good list there of the best deals out there. So if people are looking to shop around, they should go to your site and have a look and see what's available, because there are some remarkable deals there. Do your homework and save a bit of money on the way through.
Yeah, look, the best rate we've got on the lender, the saver side, is 2%. Now, 2% in this market's amazing, but I'd suggest to people if they want that, they better be quick. I don't think they'll be around for long.
Yeah, strike while the iron's hot.
There is still a few positive of 1.5, but when there are accounts out there paying 0.5%, 0.05%. You can do a whole lot better, and you should at least be doing as well as you can. And the government guarantee is there for approved deposit institutions. They're the only ones we list on our savings pages. So up to $250,000, it's safe because the government says it is.
And that's worth underscoring, right? So some of the smaller brands that you may not know about are actually paying better rates, but providing they're on that list, they have the same degree of protection as all other lenders and depositors.
Yeah, absolutely.
Yeah. Steve, thanks for your time today. Great to catch up again, and I'm sure we'll be talking again soon.
Yeah, excellent, Martin. Cheers.
Cheers. Bye.